Good morning, afternoon, or evening, ladies and gentlemen. Allincrypto here, and welcome back, guys, for another daily cryptocurrency market update. If you are new around here, every single day at 1 p.m. UK time, we release an update just like this one to help you stay up to date with the latest and greatest things happening within the crypto space and also further afield. We do a lot of looking at the kind of macro situation, which we're going to be doing a little bit of in this video in regards to looking at a paper that looks at the metadata of the laggard effect of rate hikes. And actually, this is very much tying in with our general theory that we've been reiterating now, really since the start of the year, that actually a crash isn't coming until later on. Things like the yield curve, rates in relation to the S&P and everything back up our theory. That's why we have it. You know, we've looked at data. The charts are the truth to back up this idea that a demand destructive event doesn't come until later on. And we'll talk about that a little bit in this video. It's quite self-explanatory that rates catch up with the market. And actually, the more developed an economy, the longer it takes for them to kind of catch up. But we'll look at all that in this video. We've got a number of things we want to dive into. We're going to talk a little bit about inflation, talking about macro. We're going to be looking at, of course, the Bitcoin chart. But as always, I want to start things off with a clip talking about really this industry, where it's at and where it's heading, to get you guys fired up, because right now, ladies and gentlemen, there is the opportunity of a lifetime in regards to being a crypto investor. I truly do believe that this technology, and I've never been so confident of it, is changing the entire world. Everything is going to be tokenized. Everything is going to be run on the blockchain without people even knowing that it is. And some of the blockchains that we invest in today will be the facilitators of that. That is a huge prospect. We've got lots of content coming out this week, so do watch out for all that. If you're not already a subscriber, consider doing so. A like and a comment is always appreciated. And if you want to check out the Patreon to find out what I'm buying and where I'm buying it, do check out the link in the description. So let's dive into clip number one. We've got two very short clips, and then we'll get into it all, talking about kind of the industry, where it's at, and the acceleration of it. Let's get into it, guys.
Look on the market right now as the other panelist. I would say the market is moving in the right direction right now quite fast, and even way faster than the last 2 years. Everyone expected to be able to use tokenization, and there would be a big hype around tokenization, all the DLT topics for the past years, but it didn't really came through. But in the last 6 months, even though there were quite complicated market times, I have the feeling that there is way more adaptation of the big players than in the years before. For example, that Siemens produced a 60 million tokenized financial product to have a loan tokenized was quite a big step into the market. And I think the movement and the waves that it produced were quite high. And also very other different big players are right now reaching out to us to adopt these new possibilities. I would say in the main frame is that the good products will have sustained over the last years, and like in the .com bubble, the good companies went through. And I would say also that happened to the DLT space. In the last years, we saw a lot of companies come and go, and I would say the good companies with high quality products.
Very interesting. Of course, we did see the introduction of Siemens releasing a bond on Polygon. Is what he was referring to. And also, these guys are people that are in the know and speaking to large financial institutions related to blockchain regularly. We are looking at a number of blockchains like Quant, Hedera, and a number of others that are well and truly have their feet under the table with these large institutions, along with the likes of Ripple and everything in between. It's coming, guys, and it's coming fast, and it's accelerating. Not only is that kind of world accelerating the tokenization world, you also have crypto on the cusp of becoming recognized as a global asset, starting with Bitcoin, obviously with a Bitcoin approval of a spot ETF. That is coming. And then you will have other ETFs, like in Canada, for example, you already have an Ethereum spot ETF. I've got another clip for you, very, very quick, and then we'll get into what we have to cover in this update. This is from one of the SALT panels. Let's dive into it.
Side and issuers, and I don't think this is decades off. I think this is years off, and I think we're going to start to see it accelerate, particularly with a tighter regulatory framework. Side and issuers.
It's a very short one, but the point he raises there is one that we've been reiterating. Regulations are what catapults this industry into the tens of trillions. Right now, and we've looked at clips in previous market updates, there are so many companies out there looking to utilize blockchain because it simply makes their business models more efficient. They can't come out in America and publicly say that, like Wisdom Tree and a number of others, because of fear of regulatory persecution. The SEC has done such a shit job of regulating this industry. You can only but two options. It's either complete ignorance and stupidity and lack of anything like a spine, or it's on purpose and they're trying to stall for the inevitable and work it in their favor. Let's dive into it, guys. Of course, you know what's happening from a price point of view. Right now, you are still respecting support. So we aren't going short yet on Bitcoin. We did up here discuss the possibility of a big move. We weren't really sure what way it was going to break. It broke this way. This was just a simple case of very low liquidity and an overwhelming amount of sell pressure. The sell pressure is not strong. This is not institutional players getting out and using you particularly as exit liquidity. I do not believe that. I think it was just a simple case of liquidations cascaded into this range, and now you're just chopping around, and it's just based on over leveraged longs, over leveraged shorts, chop, chop, chop. September is, believe it or not, historically one of the worst months for YouTube views. Now you've got to remember, markets are moved by you and I, human beings. That will transpire into the markets in terms of everyone's getting back to school, people are transitioning, so on and so forth. So my kind of guess is that things are just going to dribble to the downside. We've looked at a number of scenarios. Please do go and watch other daily market updates. We've looked at maybe a bit of an Elliott wave theory structure with a 5-way finishing here and the possibilities of this being an A, B, and a C, and it could be done. You hold this support, you don't go short. This could be a stage 2 breakout, or this could be an A into a B, which could be here, and then into a C, which would tie in with a head and shoulders pattern that we've got. However, the head and shoulders pattern that could be forming, remember we've got a head and shoulders pattern for 15K, doesn't fill me with a great amount of confidence given this right shoulder. I'd want to see a little bit more of a right shoulder and not just something like this, which would kind of throw the whole pattern out of whack, if you will, and then you end up in some sort of a squeezing scenario. So it's very simple for me at these levels. I'm sat on hands, until we break with momentum. I don't just want to see a drifting off in a very low liquid market, or we do something like this, we reject off these levels and we come back down, then that's your signal to go short. Vice versa, bull case is if you come. For me, I'd want to take this here, hold it convincingly, and then you look for upside. Of course, you take these levels, it's full send. We do think full send is coming. You are on the cusp of a Bitcoin ETF. Everything is going to be digitalized, ladies and gentlemen. And now is not the time to be bearish. I do truly believe that. And actually, we were the biggest bears in the room in 2022 and ultimately pivoted and still believe the crypto revival is here. But that's just my own opinion. In regards to a little bit of a drift off, you do have a lot of macro headwinds, just like you had in August, which of course has seen it drift with a little bit of cascades of liquidations. Macro headwind, what am I talking about? Well, I'm talking about $, which has been very strong. And actually, you are seeing a slight stickiness with inflation, which is putting a bit of wind behind the dollar sales. If you look at oil and the dollar, remember, most guys do not do cross-market analysis. I would say that this is potentially a stage 1 breakout, and you could be looking at a higher oil price. And if you correlate oil with the Dixie, they've been very correlated recently. So we'll see what happens on this arena. Inflation expectations are coming in at 3.4. The 3.2, the previous one from 3, was the first kind of jump that we had. Stickiness in inflation, true inflation is very much watching that. It overshoots and undershoots. It looks at a wider basket of currencies. 3.4, the next one, it kind of begs the question, are the Fed going to do more rate hikes? The thing to watch there, of course, is the 2-year yields, which we watch on this channel. And, the real question is, are they going to do more rate hikes? And talking about rate hikes, right now there's a probability that they're not of 93%, but on the CPI, this could change very drastically. But we'll see. We're watching the dollar, we're watching everything, and it's really about whether Bitcoin breaks or takes levels. That's really it for me, short and sweet. In the short term, mid to long term, we're exceptionally bullish. We expect the crypto revival to well and truly be here, guys. So, talking about rates, talking about the Rand destructive event, we've looked at a lot of things on this channel that a lot of people haven't looked at. Everyone has been calling for 2008, a crash, a demand destructive event to take place. And we've said, no, it's not coming till later on. And we've looked at data to support this, not just, oh, well, interest rates going up means that markets must crash. Markets don't crash when the yield curve is typically like this. In fact, it hasn't happened in the past 40 years, maybe barring the dot-com boom, which was a bit of a double whammy. Could argue that could be potentially quite similar. We'll see. But if you look at what happens to the S&P from every time of point inversion, markets go up. Inversion, markets go up. Inversion, markets went up into a crash, and the real crash occurred at point of uninversion. Inversion, markets go up. Inversion, markets went up. Inversion, markets went up into a crash. Well, why is this? Well, obviously, there's a lot going on with the bond market that drives. There's a lot going on with rates. Also, if we now dive over to an S&P chart, we're speeding through this, guys, because we don't want to put everyone to sleep when it comes to the macro stuff. And let me get rid of the draws. Look at the S&P in relation to rates. Put this on a log. Every time they've upped rates over the past 40 years, the S&P's ended up higher by the time they've stopped up in rates than where it was when they started. Totally counterintuitive to the narrative that's out there. And actually, the crash doesn't come until after the rate hikes. And this is because there is a lagged effect. I want to quickly read the start of this article, and then I'm going to love and leave you. Transmission lags of monetary policy, a meta-analysis. The transition of monetary policy to the economy is generally thought to have long and variable lags. In this paper, we quantitatively review the modern literature on monetary transmission to provide stylized facts on the average, facts, by the way, ladies and gentlemen, on the average, not feelings. I don't want to be that guy that says, facts don't care about your feelings, but they don't. On the average lag, length, and source of variability. We collected 67 published studies and examined when prices bottomed out after a monetary contraction. The average transmission lag is 29 months, and the maximum decrease in price reaches 0.9% on average after a 1% point hike in the policy rate. Transmissions lags are longer in developed economies, 25 to 50 months, which is kind of in line with our thinking, than in post-traditional economies, 10 to 20 months. We find that the factor most effective in explaining the heterogeneity is financially development. Greater financial development is associated with slower transmission. So the idea is it takes a lot longer to move it. And this was a great article. It really was. And in line with our thinking, which is always nice. Maybe I'm just sort of trying to prove my bias here, but it was a paper written off multiple papers that were looked at. So we'll see. Inflation, something to watch. CPI data, something to watch. Are they going to hike? Are they not going to hike? Bitcoin taking support and everything in between. But just remember where this industry is going. It's why we play clips like that at the start of the video. On that note, I'm going to love and leave you. Have a great day, guys. See you all in the next.